Hello and welcome to the Harwood Report for April 30th, 2018, presented by Trade Academy. As a reminder, all of this is for educational and information purposes only, and they're not intended as legal or financial advice. So I'm going to talk through my normal stuff here. I'm going to look at the equity indices, how I'm looking at them this week, how I am forming my trading opinions for the week. I think that there's some interesting stuff going on. The biggest three things on the fundamental inputs that I am watching right now are number one, Apple earnings tomorrow after the close. That is big for tech, it is big for semiconductors, it is big for the market because it is such a large portion of the indices and has such a great impact on other subsectors such as semiconductors. That could help the market break out of its trading range as well. We've had some good earnings last week in tech. Market hasn't really ramped off of them. I think everybody's still a little worried about what Apple could do, good or bad. We've got the Fed on Wednesday. And finally, we've got non-farm payrolls on Friday. So, with all of this in mind, I want to think through what's happening here. Oil is, of course, being impacted by Iran, and actually gold is as well. So I'll talk through a little bit about how I'm approaching that. And also gold is going to be impacted, as are bonds, by the Fed on Wednesday and on-farm payrolls on Friday. So let's get straight to it. Fear and index is 44 right now. I've been talking about how the fear and index is a little bit higher than reality. So this shows a 44 level. A lot of this is driven by the difference in 20-day stock and bond returns. A lot of that was driven by TLT weakness. TLT is starting to bounce back. The market is still outperforming bonds while they bounce back. That's getting a little bit more of a great indicator to me as opposed to when bonds were dropping and stocks weren't moving. Yield spread, whatever, that's fine. That's kind of in the same spot it was last week. The real stuff for me, this is the big key. This is all about our market momentum. There is no momentum right now. We are below the 125-day moving average. We are below a lot of other key moving averages. I'll talk about that in the chart. If we start to get some strength here, that'll start to indicate that greed level for us and press us towards 80. Without this strength, we can't get to greed. Greed is where we get too high, start looking for that really big potential liquidation. We're not set up right now for a market liquidation, in my view. We had that extreme greed in January, had that big liquidation. We've had some bounce backs, but we haven't had that follow through yet. So let's see what drives people into getting overly long the market. Well, right now, as I look at the S&Ps, we're kind of in no man's land here. What's our support level? It's pretty clear. It's the 200-day moving average. Yeah, we broke through it once in April. Nothing really major happened there, though. On the month, we're going to close this month in the green. That's a good sign for the bulls. But right now, the 200-day moving average is the support, and it seems pretty clear. This guy right here, the 100-day moving average is going to be providing the main resistance. So we look back to the prior trade, tested the 200-day moving average, kind of just rocked through the 100-day moving average. It provided support, then it broke. Now it's providing resistance. If we get through the 100-day moving average, becomes support again, keys us in for a move to 280. So what gets us there? Could it be Apple earnings? I think there's a chance. Apple earnings could start the market back into a bullish scenario, start to forgive those poor earnings and the stuff that's gotten sold off because of concerns over Apple. When I look at SMH, this is getting sold off a lot because of concerns over Apple's production. You see that break in Apple began on April 19th. It is bouncing back today. SMH's breakdown began on April 19th. So this all kind of has been correlated. So all of the tech sector has been dragged down by concerns over Apple and their sales numbers and their potential for production. If they come out and surprise the market with good earnings, I think that sets us up for the move through the 100-day moving average. Bad earnings, we have to retest the 200-day moving average, I would imagine. I'm not sure if it's going to hold. The more times you knock on a door, eventually it breaks down. So at some point, if we keep knocking, the market's going to say, well, fine, we'll try out levels below and see what it feels like. How do I trade that for this week? It's very simple. I think that we have three big catalysts, and either one of those, any one of those three should move us away from this midpoint to at least one of these extremes and maybe through it. Well, an SPY, that's a simple trade then. Let's take a long straddle. May 4th is Friday, so it includes all of the inputs. 265.5 straddle is $3.50. The 200-day moving average is $4 away. The 100-day moving average is $4.50 away. Very simple. If we go to test either of those ranges, the straddle wins. If we stay right in the middle, the straddle loses. I think this is a long straddle kind of environment though, because the VIX has come down. We bounced off of the lows. The VIX is coming back down, means options are a little bit cheaper, and yet we're still going to have, I think, a little bit more movement this week. So because options got cheap enough, since some of the earnings have already passed us by, but the big one is still in waiting, I think that there is some opportunity here. If I look at the Qs, it's a very similar story, obviously very driven by Apple. The 200-day moving average is further away, over $5. If Apple has good earnings, I don't think we stop, though, at the 50-day moving average. We're sitting just below the 100-day moving average right now. That's not going to be as important here. It's the 200-day moving average, and then it's just really recently above at 167. That was before the Apple downgrades and concerns started. So if Apple's fine and Apple pushes higher, I think this market's going to press us through 167 and consider a move towards 172. That's a lot there. I'll talk a little bit more about how I'm looking to trade that because of this potential magnitude of a move this week and forward when I go into the newsletter that is for subscribers only. Finally, I'll look at IWM. IWM's getting smaller range moves. It's performing relatively well. It's holding up relatively well compared to SPY. That's a bullish sign usually when small caps are outperforming. But we got this MACD cross. We got a couple of little flags here. And really, at the end of the day, if Apple's that bad, it's going to drag down everything, including these small caps. So the small caps, I think, are in the, what we'll call derived move for the week. They're not necessarily the driver's seat. They likely get pulled around by tech just for this week. And of course, by non-farm payrolls on Friday. Speaking of non-farm payrolls and the Fed. So yields press 3% and then bounce back. We got a good dead cat bounce here. Probably at the upper end of the range. But with the right language from the Fed and the right numbers out of non-farm payrolls, this gets movement again. If the market is more concerned about increased probability of rate hikes, then undoubtedly we should retest 117. But the market is max short, or about as short bonds as they've been in a long, long time. So that can help create a short squeeze if the Fed comes out with the wrong words, easily above 121. So again, I look at TLT. And again, I look at this week's options. It's not much vol premium to where the rest of the curve is. But if I go out to the rest of the vol time frame, look at the last 6 months. Vol basically doesn't get under 9% very often. And yet, June monthly options are 9%. So the simpler trade here is I can get a lot of time and just buy this strangle, the 119, 120 strangle for 256. It's along this put and this call. And the idea here is that if we get above 122.5 or below 116.5, that makes money, plus or minus a couple cents. And 256, obviously, we need to get to 116.44 or 122.56. But you get the idea. 122.56 is up here. So if we get the sense that the rate hikes aren't going to be as frequent, whether it's due to the Fed or whether it's due to the data from non-farm payrolls or whether it's due to just bad earnings and a concern about a recession coming in after all, this should run. If everything is rosy and those guys that are short are right, we should press down below 117 and in reality below 116.5. Once Wednesday comes through, this may not be the right structure anymore. That is the advantage of the premium newsletter. I do a midweek update. I can talk through what's changed in 48 hours, because 48 hours, while it doesn't sound like a lot of time in markets, it can be forever. So again, for TLT, I'm looking at that strangle in June, because that's not going to lose all the premium if, for some reason, we just sit right here in TLT, which is possible, because it only has 2 inputs, while I think that S&Ps have 3. This has 2 major inputs, with one really crucial one on Wednesday. I want to switch over to gold now. The first thing I always look at with gold is dollar yen. Dollar yen is basically just consolidating here after having a really big run last week. Gold today is underperforming because on dollar strength, very minor dollar strength for dollar yen, I would expect gold to be very minorly weak. It pressed back to 124. It's retesting this low. Low there was 123.58. Today's low was 124.22. Kind of trying to retest the lows from this area. If those don't hold, it opens up that first stopping point here around 121.5, that consolidation area in November, but really potentially the move down to 117. It's a big move. And because dollar yen is still maintaining its trend higher, excuse me, I got that typed wrong. Because this is maintaining its trend higher, I will maintain my bearishness in gold. We don't have a lot of great support levels for gold. That sets me up for a nice trade on the break side. But remember, the Fed's speak on Wednesday can have a big impact on the dollar. That can have a big impact on bonds, and that can also have a big impact on precious metals. Something to be aware of. Silver is testing the low end of its recent range as well, but notice that it's way below the November consolidation area, which was basically that spike high a week and a half ago. 3 days up there and then crash. The thing for me in silver is if gold gets dragged down, silver finds even less support once it gets below 1520. This recent low of 1475 is not incredibly meaningful if gold is falling out of bed. At the same time, could easily refill that gap back up to 16.25 in silver if the dollar weakens and if gold firms. And as I look at chart and silver vol, 16.5% is pretty low. Right now it's up today to 17.75. Still kind of on the low to fair side of vol. The May is the cheapest. Notice the May 4th premium there. It's not really there in TLT, but for some reason they're putting a little more front month premium into the precious metals, silver in particular. And frankly, I don't think we're just going to sit here in silver, much like I don't think we're going to sit there in TLT. A good minimum, if we're going to move, it's above 16 or below 15. Well, the 15.5 straddle here is 48 cents. That gets me above 16 or below 15, and I get my winner. If I wanted to reduce my total premium, I could look at this as a butterfly. This will be an iron butterfly I'll put together here. And you can see, conceptually, with the iron butterfly at 33 cents, if I think we're going to the extreme, that would make it worth 50 cents at expiration. I don't want to do the iron butterfly because it doesn't max out that value initially. I'll move to 15 immediately, and this picks up some premium, goes from 33 to maybe 40 or 45 at most. But I got to get well through 15 for that to max out. What I would rather do in this case is start with a straddle and update the position on Wednesday after I see what the market does from the Fed, because once the Fed reaction is out, I may have a stronger directional bias, and that might structure me better for a simple call or a simple put, a call spread, a put spread. The vol will move as well. The other key here is I don't really want to sell 16.5 vol even on the put side. Puts tend to be cheaper than calls in precious metals, but I don't want to sell 16.5 vol there. And I don't want to sell 3-cent calls, so I don't want to go all the way up to the 16.5, so it's not worth it after commissions. So the straddle is the easier trade for me at 48 cents. The miners are very similar looking in charts to silver, but I'll take a look anyway. GDX is a little bit better than silver. You note that we're at the bottom end of that November range and not really pressing the lows yet. It's kind of like an average of gold and silver. And in GDXJ, we're at the top end of that November range and not really pressing the lows yet. So again, these are kind of like the average of the gold and silver charts. They're going to be dragged around by the precious metals movement overall. That's the key to remember in the miners. Finally, I'm going to go over to oil. Oil spiked on concerns about Iran today. Netanyahu talked about Iran's secret nuclear program. So there are clear concerns that the Iran deal will basically be backed out of, and Iran will be back to not providing the world with any of their oil. That makes it bullish for oil. We cut the supply. Demand has been relatively strong as well, of course. That can create a new high for oil. Right now, oil is just letting some moving averages catch up and using the 10-day moving average as support. Get below the 10-day moving average and hold below the 10-day moving average, we may have a little bit of a pullback, 3%. But it's sitting at the highs. This gives a great opportunity for oil producers to get better hedge prices on as oil sits at highs. And so XLE is drifting a little higher, not spiking. But as oil has been sitting, XLE is up about 1%. OIH is pressing near highs recently. This is the big key level. Somehow we have to get through 29 to really get people excited. Well, what's going to do that? Honestly, probably seeing oil a little firmer. So if this Iran deal gets walked back and oil firms above $70 a barrel, the crude oil futures right now, I'll show you the price. It's about 69, a little lower, 68.5. If we firm above 70 and make a new high here, I think that's going to start getting people excited because we've changed the handle on it. So it's not that the difference in price between 68.5 and 70 is that meaningful for oil producers, but there is a psychological impact of having a different number at the beginning. The move from 49 to 50, people then start talking about $50 oil again. The move from 59 to 60, it's just that changing of the number, putting a big number in front that we haven't seen in years in oil. And that creates a very explosive setup potential for oil producers, in particular OIH, because those have a little more beta and a little more leverage to that high oil price. If oil pulls back, these names pull back too. Lincoln 25. Sorry about that, folks. On that note, I'll let that drift off. I'm going to go to the Harwood Report notice. How do I get that to stop ringing? There we go. It's done. Sorry about that. Harwood Report. That's the premium product. I'm giving the first month for free. After that's $49 a month. This is the last month that the first month will be free. I'm going to change the offer next week. So if you guys want the first month to be free, you need to sign up in the next 7 days. Next Monday, I'm going to cut it down, just 2 weeks for free. But a whole month for free, if you sign up now, gives a lot of good information. You get access to the newsletter, you get access to the midweek update, and you can decide if it's worth continuing after a month of free content. Go to tradeacademy.co/Harwood Report to sign up. Finally, feel free to contact me by email, keith@tradeacademy.co, or call me 312-600-8004. Thanks again, folks. We'll talk to you soon.